For this energy stock investing course, the plan is to provide a beginner's overview, specifically the four most important global energy sources: oil, natural gas, coal, and uranium. So let's start with the big one, oil. Now the oil energy sector has many subsectors, so there's multiple components you could potentially invest in. So when most people think of oil, they likely think of the oil producers, which are likely your integrated and exploration and production companies. But in terms of all sectors, you have exploration and production, the people making and producing the oil; midstream, which is transporting the oil; refining and marketing, which is turning the crude oil into more usable products; integrated, which is all of the above, so basically your Exxon Mobils; drilling, companies that help drill the oil wells; and equipment and services, companies that provide equipment and services to these oil companies. In terms of use cases, there are too many to count, but it is really the primary fuel that runs the world, particularly when we're talking about transportation. So when it comes to oil and petroleum products, about 66% is used for transportation, at least in the US, and another quarter of that is specifically used for industrial use. Because of how important transportation is in the economy, the price of oil has a major impact on the prices of many other goods as a byproduct. In terms of transportation specifically, it's used for gasoline, diesel fuel, jet fuel, and other heavy fuels for cargo ships and bulk carriers. And industrially, it's used in the production of other products and chemicals like asphalt, plastics, synthetic rubber, and other chemicals. In addition to transportation, oil is necessary for a wide variety of products. They use petroleum or a petroleum byproduct in their production. So when you hear people say that we're going to completely remove the use of oil, they just don't know what they're talking about. Which gets us to the investment thesis, which is demand for oil will continue to grow. And as the most globally used commodity, it also serves as an inflation hedge. Additionally, US oil companies now seem to focus more on capital returns, which is buybacks and dividends, than they had in the past. This means compared to perhaps in the past, where oil companies would drill for new wells at almost any cost in efforts to increase production, oil companies are now a bit more sensitive on capital allocation and won't reinvest back into capital projects unless they have a high enough return. Generally, we'll see there may be some exceptions later. As for market dynamics, oil, like we mentioned before, is a global commodity. And it's a global commodity market with both many producers and consumers. While there is some regional differences in price, generally the oil prices all tend to move together, at least in the same direction. And given this commodity pricing, low-cost producers or producers that can generate or produce oil at the lowest unit cost tend to have an advantage from a profitability standpoint. So how to invest in oil companies or oil stocks? Now that you have many options, you have integrated stocks versus pure play, you have large caps versus small caps, and there's many subsectors you can choose from as we discussed before. Generally, the main decision you might make will probably be, do you want to own oil and gas integrated companies, which is basically every aspect of oil production and marketing, or would you rather own the upstream, midstream, or downstream operations specifically? Now, most of the time you'll likely be looking at large cap stocks, but small cap stocks can be interesting if you know what you're looking for. Generally, in the energy space, small caps trade at lower valuations compared to some of the larger caps, but that isn't without drawbacks. Given their smaller size, oftentimes funding can be much more difficult at a smaller scale compared to a much larger company. You need to make sure liquidity is taken into account at those small cap companies. Otherwise, if they run into financial trouble or liquidity trouble and low cash, then that's going to be a rough time as a shareholder. On the flip side, small caps can be targets for acquisition by larger players, particularly when mergers and acquisition is in an active period. Though unlike maybe in other sectors where mergers and acquisitions will likely garner a large premium to the current market price, don't expect significant premiums in the energy space. There was a recent large round of mergers and acquisitions with ExxonMobil buying Pioneer Natural Resources and Chevron buying Hess. So given the recency of these large acquisitions by the integrated players, Exxon and Chevron, I think it's unlikely that they purchase anything as large of that scale anytime soon. With that all being said, let's take a look specifically at ExxonMobil and Chevron as the two main oil and gas integrated players in the US. So as integrated oil and gas companies, they are the most robust oil companies that are involved in upstream, midstream, and downstream operations. Exxon and Chevron are pretty similar. Exxon is the larger of the two technically and has more downstream refining capacity. so they benefit a bit more marginally when you see higher diesel and gasoline prices. Chevron, on the other hand, has greater natural gas production, so you could potentially see more upside from Chevron relative to Exxon when there's higher periods of natural gas prices. And potentially worth noting that of the two, Warren Buffett of Berkshire Hathaway has been buying and accumulating a fairly large sizable stake in Chevron. From a more historical price perspective, pulling up the price chart for ExxonMobil as an example. Generally speaking, longer term investors, at least from the early 2010s, haven't really been rewarded much. Part of that is due to, as we mentioned previously, oil and gas companies weren't quite as focused on capital returns as they are now. Additionally, you can see just how volatile and cyclical energy and commodity investing can be. There's a funny little meme online that describes commodity investing through these pain diagrams. You have headache, stomachache, value investing, and then there's commodity investing. So when it comes to energy investing, whether you're betting on the commodity supercycle, looking to hedge against inflation, or hoping to diversify with a sector least correlated to the market, investing in energy stocks can potentially provide an attractive asset for your portfolio, but you have to be aware of the potential volatility and how that fits in with your risk tolerance and the rest of your portfolio. So given that energy is cyclical, if you're able to get in at low prices in the sort of downswing of each cycle, energy can provide some very attractive return. There are some people arguing we may be in a super cycle here as part of a much longer term upward cycle, which may be possible and might be part of your thesis. But even so, it's important to keep in mind that short-term commodity prices are nearly impossible to predict, though there will still be short-term volatility at least. Moving on to the upstream or exploration and production oil and gas companies, these are probably what most people think of when they think of oil and gas. These are the companies that actually extract the oil from the ground. Now for this, I'm actually going to pull up the FinViz S&P 500 heat map. We're going to zoom in on the energy sector just to get a closer look at the companies that are here. So when it comes to all the energy stocks in the S&P 500, this square is basically your smorgasbord of what you're choosing from. There are others as we'll get to, but these are probably the main ones. So as we mentioned before, we have the ExxonMobil and Chevron as your oil and gas integrated. But then over here to the right, we have the oil and gas exploration and production. As mentioned before, Pioneer Natural Resources and Hess both got purchased by the oil integrated players, but the remaining still stand as independent companies. Now, what's important to note for US-based exploration production companies is that most of the companies large in size in this group primarily operate in the shale oil fields in Texas like the Permian Basin. They use a technique called fracking to drill long horizontal wells into the ground, inject water and sand at high pressure, and use that to pump out the oil. Now, the technology has gotten better over time, so now wells can be nearly 3 miles long or more. This is a slide from one of Pioneer Natural Resources' past presentations, which describes how using longer wells can produce better production yield and more oil output per well. This in turn also lowers the cost of production. A byproduct or sort of second level thinking about this is that companies within the Permian Basin that have large contiguous acreage, so large plots of land that are all connected to each other, have the best ability to build and create these long horizontal wells across a wider area. So having contiguous acreage is a competitive advantage in this space compared to companies that have a lot of spotty, unconnected acreage within the Midland Basin. Pioneer Natural Resources was one company that I actually did invest in, and primarily for two aspects. One of them was this contiguous acreage, as well as their best-in-class capital returns program. And this is why ExxonMobil was so interested in Pioneer, is because Pioneer had such a large swath of the Midland Basin, and it actually lined up fairly well with the sort of scattered holdings that ExxonMobil already had. And additionally, when you are an oil producer, you do need to replenish your reserves either by exploring and looking for new oil or by purchasing and acquiring other oil companies with proven reserves. In this case, that's what ExxonMobil did here with Pioneer. So when it comes to oil and gas exploration and production, why would you want to buy one of these companies? Well, these are the companies that have the most upside when it comes to oil prices. Because these are the first in line, first producers of oil in the value chain, they get the most direct upside when oil prices rise. But conversely, when oil prices decline, they will also see the most downside, at least compared to the midstream and downstream, also known as refining and marketing, which are later down in the value chain of oil. If you're looking for an inflation hedge against specifically the rise in price of oil, then oil and gas exploration production might be right for you. On the other hand, if you're looking for maybe a more stable form of income or returns generated from the oil and gas industry, oil and gas midstream could potentially be an option for you. Most oil and gas midstreams own a large network of oil and gas pipelines and storage tanks to help transport the oil produced in Texas and other regions to refineries or downstream operations, where then the crude oil will be processed into more usable fuels and products. So you can think of midstreams as sort of like a toll road for the oil and gas industry. These vital pipelines make transportation of crude oil much more economical for E&P companies without their own pipeline infrastructure. So those upstream oil producers are very happy to pay for using these pipelines. What this means from an investor perspective is that the income from midstream oil and gas companies is very stable. But the drawback to this is that there's much less upside should crude oil prices rise significantly. This can make midstreams quite appealing to income investors or those who want a steady and predictable dividend or distribution payment that is likely somewhat protected from inflation. And to give an example of what these pipeline networks look like, we'll take a look at Enterprise Product Partners, which is one of the largest oil and gas midstream companies in the US. As you can see, they own a vast distribution network which helps transport both crude oil and natural gas to various storage sites as well as refining and marketing companies where they are eventually processed for further use. Now, there is one extremely important caveat or thing you should know before investing in oil and gas midstream companies, and that's whether or not the company is set up as a corporation or as a master limited partnership. Master limited partnerships, or MLPs, are a business structure where the business income of the company isn't taxed directly, but it's passed on to you on your personal income tax return. If this sounds a bit complicated to you, you're not wrong, it is. In fact, if you invest in a master limited partnership, at the end of each year, typically late in the tax season, you'll be issued what is called a K-1 tax form. So for US investors, that K-1 tax form is a relatively complicated tax form compared to others that you may be familiar with. But this basically breaks down the portion of the business's income and or net loss that is passed on to you to your personal tax return. There are several main takeaways here, but one of them is that if you invest in an MLP, it's going to make your taxes a lot more complicated. This on its own is enough for many investors to say, I'm going to pass on this because it just isn't worth the extra hassle, especially if it's relatively small or only a moderate sized position in your portfolio. It may just not be worth the extra effort given the potential for other alternative investments in the space that don't require a K-1 form. Potentially though, one of the maybe advantages of MLP structures is that because these pipeline companies have large capital expenditures, they have large depreciation expenses, which means those get passed down to you on your taxable income, which if large enough, allow the distributions, normally called dividends, but for MLPs they're distributions, those distributions may end up not being taxed as long as it's less than the depreciation for that year. However, you shouldn't consider it a fully tax-free distribution because when that distribution occurs, it lowers the cost basis of your account. In other words, when you eventually do sell that MLP, you're going to realize more capital gains because those prior distributions lowered the cost basis. So in other words, it's like instead of paying dividend tax on the large dividends from MLPs, you're now paying capital gains taxes instead at a later point in time. If you're a tax guy and that all sounds extremely exciting to work through those challenges, then investing in MLP might be okay for you. But if you're like most of us who really don't want to deal with the extra tax headaches, MLPs probably aren't a good investment to choose from. Now, I have personally owned Enterprise Product Partners Limited Partnership in the past, and from a return standpoint, I did like the low volatility energy investment with a large and increasing distribution yield. On the flip side, I was not extremely excited to deal with a K-1 tax form, and it did add significant effort in preparing taxes each year. Overall, I was happy I invested in it, but I decided to eventually sell to eliminate the need to process that K-1 tax form for future years. When you look at the longer term chart for enterprise product partners and many other MLPs, the returns over the last 12 years or so, at least from the 2010s onward, likely probably don't look that great. And part of the reason for that was in the early 2010s, there was a large run-up in price and valuations for these MLPs. So basically by 2014, before the oil crash in 2015, these MLPs were extremely overvalued. So if you were investing near that top in that 2014, you probably didn't make much money. You still got your distributions over these years, which likely puts you ahead, but overall, compared to other alternatives, it was not a great bet. Like we saw though with the Exxon price chart, if you're able to buy at a low enough price, it can be a worthwhile investment, providing not as much capital appreciation or capital returns at these levels, providing a very significant distribution percentage. You'll notice in the oil and gas midstream companies in the S&P 500, Enterprise Product Partners is not on this list, and that is because it is a limited partnership or MLP. Only the oil and gas midstream set up as corporations are in the S&P 500. So this is basically a list of a few of them that you could consider investing in if you wanted oil and gas midstream exposure, but didn't want to deal with the K1 tax headache. And another important thing to consider for midstreams, especially if you're looking at one that's an MLP or requires that K1 tax filing, is sort of two things. One is that if you're a US-based investor, do not invest in MLPs within retirement or tax protected accounts. Because of the way MLPs are taxed, if you have distributions above a certain level, it's going to cause a lot of headache and problems if you have them in your retirement account. I don't want to spend too much time explaining that, but you can look into it. Basically, only invest in MLPs if you do invest in them in a individual taxable normal brokerage account, not in any retirement accounts. And the second thing is, if you're a non-US investor or international investor, investing in MLPs is likely something you do not want to do. And the reason for that is when you invest in MLPs as an international investor, your distributions get withheld at the highest marginal tax rate possible for the US. In this case, currently that's 37%, though the Biden administration is trying to raise that potentially as high as nearly 45%. So either way, a large portion of that MLP distribution income that you might be expecting as an international investor, you're not going to see because that's going to be automatically withheld, basically cutting your dividend or distribution amount by a third and potentially in the future by almost 50%. So for MLPs, don't invest if you're an international investor. If you're a US investor, don't invest in a retirement account or tax preferenced account, and also don't invest if you don't want to deal with the K1 tax filing, which is perfectly fine and a valid reason for not wanting to invest in specifically an MLP midstream. For the corporate midstreams or the midstreams that are set up as a corporation, those are just fine and don't have to deal with any of the constraints I just mentioned. Now, the next sort of section you can look at is oil and gas refining and marketing. These are downstream oil and gas operations. The reason it's downstream is because the oil in the upstream is produced, that's the crude oil. It's moved, transported through the midstream, and then through the refining and marketing, it gets turned into more refined products and then marketed out to other companies and end users. One way to think about this is all the gas stations in the US and really in the world get their gasoline, diesel, whatever fuel they provide from these oil and gas refining marketing companies. In the US S&P 500, there's 3 refinery companies here. One is Marathon Petroleum Corporation. The next is Phillips 66, as well as Valero Energy Corporation. So I'm going to pull up Marathon Petroleum Corporation in FinViz real quick to sort of show the financials of the company. And the main thing I want to take away here is that these guys process a lot of petroleum products. In this case, Marathon has sales of roughly 150 billion and trailing 12-month income of roughly 8 billion. So this is a lot of money, but one thing to keep in mind is that the margins for oil refining and marketing are much lower than the upstream producers. In this case, profit margin for MPC is about 5%. If we compare that to ExxonMobil, an integrated player, they have a profit margin of 10% or roughly double that. Now keep in mind ExxonMobil has all pieces of the value chain for oil, but if we compare to a pure play oil and gas exploration and producer like Pioneer Natural Resources, which we've discussed, their profit margins are 25%, 5 times more than Marathon Petroleum Corporation. That's one of the main takeaways from a business perspective for Marathon Petroleum Corporation, as well as oil and gas refining and marketing companies in general, is that they're a high volume, low margin business. But that doesn't necessarily make them a bad investment. Part of the reason is that due to onerous and restrictive environmental regulations, it makes it very unlikely that another refinery will ever be built in the US again. Because of this, all US oil gas refining capacity will effectively be restricted to the companies that already exist, which means these refineries become rather strategic assets potentially you could own, which are necessary to help supply the country and the world with the refined fuel products it needs. Looking at Valero as another example, these companies have generally seen more steady long-term price increases than both the midstream and upstream counterparts. This may be slightly due to the fact that, at least domestically in the US, there are limited new entrants into the space. While these companies still do compete on a global scale against other oil and gas refining marketing companies, given the difficulty and time to build new refineries, it's unlikely there'll be a significant influx of new competitors. So if you're interested in investing in refining marketing companies, specifically for increases in, let's say, gasoline or diesel prices or other byproduct fuels, or like the aspect that these will be relatively rare assets in terms of an oil refinery, which likely won't be reproduced again in the US. In that case, then oil and gas downstream companies might be a compelling investment for a portion of your portfolio. Additionally, although I won't go into as much detail on these, you do have oil and gas drilling companies, which help drill and create the rigs that many of the integrated and upstream companies use, as well as oil and gas equipment services companies that provide, as the name implies, both the equipment and services for many of the companies above as well. On the drilling side, it's important to know that oil wells aren't meant to last forever. This is a graph of annual production of oil wells for the year that they were drilled. And as you can see, for each cohort, the oil produced starts out high, but then gradually reduces over time. Because of that, over half of the production we have today is effectively from new wells that are under 18 months old. Because as time passes, the amount of oil extracted from the wells decrease, you have to continuously drill new wells if you want to maintain a certain production level. The way to imagine this is think about a full gallon of milk and now take off the lid and just put the gallon on its side. A lot of the pressure from the milk will spill out at first, but as that pressure releases, the flow is going to slow down to almost a trickle over time. The rate of flow from an oil well will follow a similar pattern, just over a longer time horizon. It's going to be max flow at the start, followed by a gradual decline. At a certain point, it becomes more economically viable to drill a new well to restart that oil extraction process at that higher rate again. It's these drilling companies that help the upstream E&P companies drill these wells. Now, some specialize in onshore versus offshore, and there are many more onshore rigs than there are offshore. However, one thing to keep in mind, sort of going back to that Pioneer Resources slide again, is that as technology and industry practices have improved, rigs and their placements have gotten more efficient. So fewer rigs are needed now than are needed in the past to maximize that rate of economic oil extraction. What this means for investors as sort of a second level thinking is that if this trend continues, it could potentially mean a declining need for drillers beyond the location of old wells. Another way to put that is that if fewer wells are needed to get the same amount of oils, then fewer wells need to be drilled. That being said, oil and gas drilling is still an essential service for these oil companies, so even if the number of wells being drilled is declining, they likely can and should be able to make that up through pricing over time. On the oil and gas equipment and services side, these are companies that provide equipment and services for oil exploration and extraction. This is a more niche angle to invest in oil, and most probably are better served with simpler thesis of either upstream, midstream, downstream, or just going with an integrated player like ExxonMobil or Chevron. However, there are some use cases where equipment and services might make sense to express a targeted belief or thesis about oil. So for instance, if you look at global oil supply growth over the last decade or so, from say 2012 to 2024, almost all of that production has come from US shale oil, like in the Permian Basin, like the Midland and Delaware Basin. And it's important to note that these reserves aren't infinite, and the economic reserves, are the oil that you can extract at an economic or profitable price, are even less than that. So over time, we're talking sort of a much longer time horizon, so over years and decades, but over time, those economic oil reserves will gradually be depleted. As that happens, in order to satisfy the new demand, supply will likely need to come from somewhere else. In this case, most likely offshore drilling and exploration. So a more niche targeted thesis would be that companies that provide those offshore drilling rigs and supplies may have a long-term tailwind as offshore starts to become the new oil supply to replace and supplement the gradually declining production from the Permian Basin. Though Tidewater is one example of this who has been benefiting from the increased offshore demand. Though I will say that this stock price chart from 2021 to 2024 is a little misleading in terms of the longer picture here, because oil and gas equipment and services is a very volatile business, and many of these companies are highly or were highly leveraged. So if you look at the longer term returns, they aren't pretty for Tidewater. And the reason for this is in this 2014 period, this is when oil prices were still quite high at over $100 a barrel. But then we saw the oil price crash in 2015, and all of a sudden, it's no longer profitable to be drilling new wells. Because of this, equipment and services companies saw a massive decrease in revenue as upstream companies stopped drilling wells, assuming that oil would be at $100 forever. They realized, well, the price is now lower and a lot of the wells we drilled are not profitable. So revenue collapsed, and also because these companies were often highly levered, they had to significantly dilute shareholders through share issuance in order to stay afloat. That's why there's such a significant decline in the stock price here. Is effectively the company almost went bankrupt, but avoided that through massive stock dilution. So leverage is something you definitely want to keep in mind with these oil and equipment services companies, though perhaps if there is going to be a long-term trend towards increased offshore drilling over the long term, that may provide a tailwind for that. The leverage is definitely something to keep in mind for these companies. So that is basically the full overview I have for investing in oil energy stocks. And hopefully that provides you a better, more holistic view of the energy sector, at least for oil. There are many different routes you can go to investing depending on what your specific investment thesis is and what you think the long-term oil price likely ends up being. As mentioned before with that meme, commodity prices are very unpredictable and impossible to predict in the short term, but you may be able to express long-term views on energy prices if you believe that oil demand will continue to grow and supply may be limited as companies focus more on capital returns, at least in the near future. Now, when talking about oil, it's also important to talk about natural gas. The next main sector I want to look at is natural gas, so investing in natural gas energy stocks. This is a much smaller sector compared to oil. Oil is massive and huge, but a lot of times the oil companies will also be producing natural gas as well, if not directly, then as a byproduct of the oil production process. Within natural gas, it's a little bit smaller of a subsector setup. There's fewer options in terms of natural gas since there's fewer dedicated natural gas producers, but it's split up a bit like before. You have your upstream exploration and production companies, as well as a few midstream companies. And then you have the decision whether you want an integrated or a pure play natural gas producer. Now, the use cases for natural gas is that it's a very clean burning fuel for electricity generation, heating, and industrial use. The investment thesis for natural gas might be that demand will grow as a baseload energy paired with renewables, replacing coal for electric generation. Now, what that means is effectively natural gas serves as what's called a base load energy. Another way to look at this is that natural gas is likely going to replace coal for electric generation, and since renewables have on and off periods where they generate energy, whether that's solar or wind, you have to pair it with some kind of base load energy producer. Put another way, renewables like solar and wind just simply aren't consistent day to day with their energy production. Solar being the most obvious example of this. When the sun is not out, you're not generating any energy. So because of that, you need to pair these renewables with base load supply. So that source of energy has historically been coal, as you can burn that at any time And so you can use that for most of your primary energy demand. However, over time, that's gradually being replaced with burning natural gas. And as more renewables are put onto the grid, you're naturally going to need more base load. And natural gas serves as one very potential option that can easily ramp up and ramp down to help serve some of that base and even variable load. You can see this dynamic in the electricity markets in California, which is probably one of the more broken electricity markets in the US. In this case, given the significantly high level of solar and wind in the California grid, they produce so much solar energy in the afternoon that a good portion of that is simply curtailed or completely wasted. But given that this solar energy drops once the sun sets, they have to replace that energy generation with primarily natural gas generation and importing energy from other areas likely generated by natural gas. Wind generation is also variable, but a bit more stable than solar, and hydro energy is fine, that's very stable. But the main issue is that since solar energy is so inconsistent, which is predictably inconsistent, but still inconsistent, you have to have the built-up gas infrastructure or some other way that you can absorb this energy demand when the sun sets. So that's the benefit use case of using natural gas for more electricity generation. And yes, the prices do go negative midday because of the ridiculous amount of excess solar energy. And this is one of the major problems with solar that isn't discussed enough, is that not only do you have to chop down acreages of fresh forest land to build these solar plants, and then eventually replace the panels and put them in the landfills where toxins leach over time. Even discarding those aspects, your electricity generation is still limited to the solar cycles. So when the sun sets, you still need the underlying fossil fuel generation. So theoretically, you could have saved yourself all the effort and environmental destruction of building those solar panels and cutting down all those trees to make space for the solar panels by just keeping and utilizing the natural gas generation you had during the midday, in which case you would be burning a clean burning fuel, not using coal, and you'd also stabilize your energy grid and make it much more resilient. But that would make too much sense, and it is California, so you know that's not going to happen. Getting back on track to market dynamics, natural gas is a byproduct of crude oil production. So when oil is being drilled, for the most part, a portion of that is going to be natural gas coming with it. Something to keep consider, at least in the US market where we have a large supply of natural gas, is that we really depend on pipelines to get natural gas to where it needs to go in terms of electricity generation or industry use, because our natural gas or liquefied natural gas export capacity is relatively small. Additionally, natural gas pricing is very sensitive to weather. So if we have a particularly cold winter season, much more natural gas is used to heat homes, and prices will rise much more significantly. If you have a relatively warm winter, because not as much is being burned for heating homes, you have a relative oversupply of natural gas, and prices can come down very quickly. This is somewhat even more exacerbated by the fact that we have limited storage capacity for natural gas. To get an example of this, we can take a look at sort of the long-term natural gas futures prices from 2008 to 2024. And as you can see, it is very volatile. Periods that typically go up, periods that typically go down, and many spikes in between. In particular, during the energy crisis 2021-2022, we had a very significant increase in the price of natural gas. Part of that is due to Europe cutting off the supply of Russian gas, so that has to be replaced with other gas or other fuel supplies. That caused a significant increase in the price of natural gas for both the US as we export it to Europe, and then, as we'll learn and go in later, also increased significantly the price of coal. But since the last couple winters in 2023, 2024 were quite warm, not a lot of natural gas was needed, or not as much as was potentially could have been needed. So the price dropped significantly, almost 80%, from roughly $10 to $2. Looking at the more longer term view again, this is oftentimes why the natural gas is referred to as the widowmaker trade in the commodity space, because of just the extreme potential for volatility. This is an even more longer term chart of the US natural gas price. As you can see, even back in 2000 and 2005, you have some very significant spikes as well as declines in the price. And this is really reflecting when natural gas is in short supply. So if you understand that natural gas prices are quite volatile, but still believe potentially that they may increase in the future, you might consider investing in natural gas. Now, there's a couple ways to do this. You can go pure play natural gas producers, or you can go a bit indirect through an oil company. There's also the midstream option, but one thing that I will say is definitely avoid leveraged and futures products like Boyle due to the Decay and Contango. Now, Decay and Contango are things to deal with both options and futures contracts. I won't get into too much detail in that, but I'll show you what the price chart for Boyle looks like, and that'll sort of explain the effects of those two. So Boyle is the ProShares Ultra Bloomberg natural gas 2x shares, and what that effectively means is that it's trying to track the daily price of natural gas on a 2x leverage. So basically, whatever natural gas price moves in a day, this exchange traded fund is trying to double that each day. There's many problems with this. This fund probably suffers from both Decay and Contango, and also just the inherent fact of leverage as well, which is that losses are going to hurt more than gains. So if you have, let's say, natural gas goes up 100% and then goes down 50%. Overall, after that, the natural gas price should be the same. However, with a leveraged position, the natural gas price ETF will actually be significantly lower than before. So this is from like 2021 to 2024. So if you invested in Boyle, let's take that back. There's no investing in Boyle. It's basically speculation. So if you speculate on natural gas prices increasing, and let's say you did that in 2021, you might have been able to, say, 5x your money, which sounds great. But the thing is, the volatility of that is so insane, and the risk is basically, let's say you were a little late, and let's say you bought at 2,000. So you go up to, let's say, 2,500. You're up 20%. Which is not that great in a leveraged product. You then lose almost immediately in the course of 1 month, 50%. That's how extreme these leveraged products are. And then say you go back to 2000, but then after this point, if there's a decline in natural gas prices like you saw, you basically get completely wiped out. So the split adjusted price of Boyle at that point would have been equivalent to 2000 compared to what the share count is today. So at the September 2022, owning Boyle, you have basically a price of 2,000. And then in the course of less than 1, 2, 3, 4, 5 months, we'll even go 6 months. So in basically half a year, you lose 95%. So you're down 95% in a year, and you never get that back because of how the way the ETF is structured. And this is due to the triple whammy of leverage, making the losses worth more, Decay, which is a natural feature of options products like this, where you're guaranteed to lose money over long periods of time, and also Contango, which can happen in futures markets, which will also start to continuously erode at the value in the ETF. And just to get a view of this long term, these numbers are hard to see, but I think this is 700,000, which would be the equivalent starting price of Boyle back in 2012. And so you would have gone from 700,000 to $13 today if you held for 12 years. So these products are designed to lose money in the long term, but they're basically for speculators and short-term traders to try and bet on natural gas spikes. That's all this product is for. This is not a product designed for long-term bets on natural gas. I see this a lot in like new investors that think, oh, well, I want to invest in natural gas, I'll just buy Boyle. That's not what you're doing. You're not investing. You're just speculating for a spike without knowing it, because these products are toxic to long-term investors, and they will completely erode your capital over extended periods of time. That may sound like a big off tangent, but I have seen many investors buy shares in Boyle thinking, oh, it's going to go up because natural gas prices go up. And it will in the short term, but the problem is you can't hold this very long, and you need to be right in the short term for it to be profitable. If you're wrong and say, oh, I'll just keep holding on a little more, just wait, it's going to spike any day, it could be, a few months, and then 6 months later, you've lost 90% of your money in a bad case scenario. In a worst case scenario, you might lose like 97% of your money. In maybe an okay scenario, you only lose 50% of your money. But still, that's like an unacceptable loss to most people, especially if they don't know exactly what they're investing in when they invest in Boyle. So large tangent aside, do not invest in Boyle. If you want to speculate in Boyle because you think something imminent is going to happen to natural gas price, understand that you're speculating and understand you'll probably lose your money there, or at least a portion of your money. When it comes to relevant stocks, there are a few natural gas producers that focus primarily on natural gas, Antero Resources and a few others. I put CEIX here, which is Chevron, which is the integrated oil and gas producer we discussed before. And the main reason I have them here is that they are one of the larger players in the natural gas space. So despite being mostly oil focused, they do have a large natural gas presence as well. So if you're looking maybe for a balance, you want to invest maybe with a little more tilt to natural gas or a little more allocation towards natural gas, Chevron could be a more diversified way of doing this. Now, there are a few dedicated natural gas midstream companies, but I'm not quite as familiar with these, so I would suggest taking a deeper look into them if that's something that interests you. I think natural gas exporting to Europe is one thesis that some people have, believing that it'll be a longer-term structural source of demand as Europe will continuously need US natural gas to replace the gas they were getting from, let's say, Russia. In the past, I have invested in Antero Resources and actually lost money on that. Part of the reason is I was not fully prepared and ready for both the natural gas volatility and also the volatility that comes with some of these equities or stocks dealing with natural gas. So that'd be one sort of maybe warning caveat to keep in mind, is that unlike maybe oil, which is still volatile, oil's more of a stable market, whereas natural gas, at least natural gas prices in the US, we supply so much that the demand can really swing quite wildly given the limited storage capacity and limited export capacity. If you have a cold winter, prices can spike quite high. If you have a warm winter, prices can crash ridiculously low. So if you're investing in natural gas stocks, make sure you're comfortable with the volatility that comes with natural gas pricing, at least in the US, as well as understanding why specifically in terms of the energy commodities you're investing in, why you have that portion specifically for natural gas compared to, let's say, oil or coal or uranium, as we'll get to in a bit. If you're looking for maybe just more of a tilt towards natural gas, then Chevron might be a reasonable way to express that view. That's what Buffett's been buying in terms of an integrated oil and gas player, and it's a little bit more of a diversified option where you get some upside if natural gas rises, but you don't see as much downside compared to the pure play natural gas producers. So now I want to talk about coal, and coal is probably the most hated energy asset there is. I'm trying to think if there's one that's more hated than coal. I don't think there's one that comes to mind. So when it comes to coal, maybe most people aren't familiar with the types of coal, but there's two main types of coal that are being used in the world today. And one of them is thermal or steam coal, and the other is metallurgical coal. Now, the use cases are very different for both. Thermal coal is much more common, and it's the most common electricity generating fuel globally. So when we think about across the entire globe, what is the most common way that people get electricity? It's burning thermal coal. Now, that's been declining significantly in the US as a percentage of electricity generation, but even to this day, coal is still the #1 production of electricity generation for the world. The other coal, which is much more rare, is metallurgical coal, and this is required for large-scale steelmaking in what are called blast furnaces. And specifically, the metallurgical coal is used to make a component called coke, and that is used within this blast furnace process. So the investment thesis for each of these types of coal is actually quite different. So for thermal coal, the investment thesis would be that transitioning from coal electric generation will take longer than expected, especially in developing countries growing output. So in this case, let's say India. So another way to think about that is that it's not like you can just flip a switch and turn off all the electricity generated from coal and then we can find some other way to do that tomorrow. You simply can't do that. Coal is still producing the majority of the energy for most countries, especially for developing countries. And not only is it the most used fuel for electricity generation, it's actually growing. So in countries like India, they're producing more coal and producing and building more coal plants. Same with China. So thermal coal will still be used for quite a while. That being said, there's still lots of headwinds for thermal coal, especially as developed nations try to transition away from it. Metallurgical coal, on the other hand, is a different story. And the thesis is pretty simple. There is no substitute for coke or met coal in the blast furnace steelmaking process. If you don't have met coal, you cannot use blast furnaces for steelmaking. And the issue is, you might say, oh, well, we have EAF furnaces, which can use recycled steel. You can, but that is not going to meet the global steel demand. And there are many applications, whether it's for automobiles or for steel beams for buildings or other parts, where you simply need new steel constructed. And for situations where recycled steel from EAF furnaces simply won't fit the job. Given this, there will likely be strong met coal demand as long as demand for steel remains high. Now, I will point out there have been some talks of trying to use hydrogen as a substitute for met coal within the blast furnace steelmaking process, but that is likely a long way away. And even so, if it does, the technology gets better over time, it's unlikely to have the same efficiency level as metallurgical coal currently has in the blast furnace steelmaking process. So long story short, while thermal coal likely will be pushed and moved out of developed countries in terms of electricity generation, metallurgical coal will always be used and will always be with us. Now, the investment thesis for US coal becomes sort of interesting because you have most of the US coal companies now focused very heavily on capital returns, primarily through buybacks, with the exception of Warrior Met Coal, which we'll get to in a bit. Because many of the US coal companies are trading at very low valuations, remember that this is the most hated asset class in the energy sector, many of these companies have been able to significantly reduce their share count through these buybacks much faster than maybe most companies running a share buyback program. Whether or not this will continue to provide outsized returns for coal investors depends largely on the coal price in the future. And on that price, speaking on market dynamics, compared to the oil market, which is a very global market, coal is more of a localized market, and there are many different grades of coal. Within both thermal coal and metallurgical coal, you can have coal at very different grades. So some burn hotter than others, some burn cleaner than others. And what happens is that when you have electricity generating coal plants, for instance, with thermal coal, they are designed specifically to operate most efficiently using a certain grade of coal. Now, they can operate at other grades of coal as well, so it's not like it's completely inflexible. But most of the time, when you set up and optimize a plant for efficiency, you end up using a certain grade of coal and likely will stick to that over time. This makes building relationships between suppliers and end users, like utilities, a very important process, because if you can build that relationship and they like your coal, for instance, if you're a coal producing company, then if you can build and establish that relationship and provide value in that respect, then they may continue to purchase coal from you as you have the specific coal that they've now optimized for. And it's a similar story with metallurgical coal, where you have different grades and qualities as well. So how to invest in coal? Basically, when it comes to coal, you have two decisions to make, either primarily met or primarily thermal. Now, you do have Australia in comparison to the US coal miners that does have some pure play coal miners as well. But in this case, I'm just going to focus mostly on the US coal producers and then the relevant stocks here. So for thermal coal in the US, the main sort of big players are Consol Energy, Peabody Energy, and then Alliance Resources. I will note that Alliance does require that K1 tax filing, so that may be a non-starter for some investors. On the metallurgical coal side, you have Alpha Metallurgical Resources, you have Arch Resources, which does actually still produce some thermal coal in the Powder River Basin, and then you have Warrior Met Coal. Now, when you take a look at the stock price of some of these coal companies, you might be quite shocked, especially if the one you look at is Alpha Metallurgical Resources. So Alpha, or AMR, went from a low in 2020 of roughly around $2 to reaching a relatively recent peak of $450 in 2024. So from $2 in 2020 to $450 in 2024, or in other words, it increased over 200 times in basically 4 or 5 years. So the question that might come to mind is, why is that so extreme, and why has some random coal company been a 200 bagger over the last 5 years? Well, if you look at prices of AMR stock in roughly 2018, 2019, they were trading at roughly maybe $60, $70 a share at that point. What happened is in 2020, when prices significantly declined, you have all sorts of issues potentially with supply chains and things like that, getting the mines to operate at a cost-effective manner. Effectively, there were significant concerns about bankruptcy for Alpha. And that's why the stock equity has declined so much, is because people are wondering, is the company even worth anything? Is the stock a zero? We have pessimism at all-time high, and which is why prices are at all-time lows. Then what happens is from 2020 to 2021, we start to see inflation picking up, we start to see spending picking up, and we also start to see infrastructure spending picking up. We have a lot of new steel demand, which is increasing metallurgical coal prices. Then, as we head in, we're starting to see an energy crisis start to appear as people are realizing we actually don't have enough energy, electricity. And this is partly due to something happening in China where there wasn't enough hydroelectric power due to drought. So they have to make that up with increases in use of coal power. And additionally, there is something that happened in 2022, I think involving a country called Russia. Not really sure about the details of that, but effectively that caused a significant increase in the spike of coal prices because all of a sudden, Europe doesn't want to use natural gas from Russia. And in a few months later, they actually can't get natural gas from Russia. Something happened to the pipeline. Not really sure what happened there, but you can look into it. That is all to say that the prices of coal simply exploded, both metallurgical coal and thermal coal. In fact, it got to a point where thermal coal was actually higher than metallurgical coal, which almost never happens. But the end result for Alpha and many of these other coal miners is that you have these companies that were almost on the verge of bankruptcy now seeing a massive inflow of cash. So what Alpha did is they decided, we're going to take that cash and we're going to pay off every single penny of debt that we have. So in this case, the company is now completely debt-free. They use that cash inflow to purchase, rebuy back all their debt, so they have no debt payments. And then after that, once they're debt-free, they decided, well, if we're still generating all this excess free cash flow and our stock is trading at extremely low valuations, let's just buy back a large amount of our stock all the time. And that's effectively what they did, buying back their stock continuously almost every day through that entire period. And eventually, over time, they cut their share count down by around 33% or a third, and the stock finally started to re-rate higher. You can see a somewhat similar story for Arch, although Arch was in a slightly better financial position heading into 2020. You can see a similar story in terms of the price chart, although not quite as extreme in terms of the price declines and price increases, but still a similar pattern. And Warrior Met Coal, again, similar pattern there for met coal. Now, Consol Energy is one of the thermal coal producers, and what's interesting about thermal coal in the US is that, domestically speaking, it's on a significant decline. As we discussed, thermal coal is being phased out gradually by many developed countries, including the US. So why would there be any reason to invest in a thermal coal stock? Well, the reason for that is that Consol Energy has not just been sitting on their hands for the past 5 years. They've realized that if they continue to focus on domestic sales of coal, that they're going to go extinct pretty quickly. What they've done is they've actually shifted a very significant portion of their production to being sold overseas in the export market. So in this case, from 2017 to 2013, sales to domestic power generation decreased from 61% to 13% of overall sales. And over that same period, export sales have increased from roughly 28% to almost 60% in 2023. As this trend continues, Consol Energy will become more and more focused on being an export provider of their high-quality thermal coal product. And the other main attraction of coal is typically the very low valuations. So in this case, Consol Energy is trading at a price to earnings ratio of the last 12 months of earnings of roughly 4, expected to be a future 12-month price to earning ratio of roughly 6, which compared to many other stocks and sectors, even for cyclicals and energy stocks, is quite low. Now, one potential risk with Consol Energy, at least temporarily right now, is that with the closure of the Francis Scott Key Bridge in the Baltimore port of Maryland, Consol's main terminal, which they own completely, is the Consol Marine Terminal in this port. So this is basically all of Consol's coal. You can sort of see the different grades of coal that they have here in different piles. But this is their marine port that they own completely. And right now, this is their primary way of exporting coal to the world. And since they're now primarily an export company, with this port shut down for at least temporarily right now, they're not able to get their coal out from this port. So they have to redirect most of this coal to other ports currently. It's not certain when exactly the port will open up again, but given that coal bulk carriers are one of the heavier ships, it likely will be one of the last ships to be available to leave once the wreckage and debris from the bridge is dredged and completely cleared from the channel. So that is a short-term risk to consider with Consol. It may impact valuations short-term, which could potentially be a long-term buying opportunity once it clears up, but that's up for you to determine for yourself given the risks and the prices. But just one thing I should bring up, given that that is something that's preventing their coal to reach the market at a more economical way. Obviously, this is much easier than having to ship it to other rail lines and other ports that they don't own. So I actually own or have owned 4 of these stocks: Consol, Peabody, Alpha, and Arch. With the exception of Peabody, most of those worked out fairly well for me. They were bought at relatively low prices compared to where they are today. Now that the stock prices of many of these coal stocks are higher, and generally coal prices are lower than they were a couple years ago, I'm not quite as excited on coal as I used to be, but it's still something I keep an eye on, as it is one of the cheapest energy sectors by most traditional metrics. Investing in these coal stocks, speaking from personal experience here, can be very volatile, so just understand what you're getting into if you decide to invest in coal. Make sure you understand the thesis, whether it's thermal coal, so say thermal coal export with Consol, or if it's long-term metallurgical coal with, let's say, Alpha Arch or Warrior Met Coal. Understand why you're buying and what's the reasoning behind that. And that way, if you see the price going down, you take a look back at your investment thesis and it hasn't really changed, then it can provide you a little more sense of stability, even though short-term volatility can be quite high. And I mentioned Warrior Met Coal as sort of an outlier in the met coal space, primarily for the lack of share buybacks. And despite this, the price has still increased quite significantly. Part of the reason for that is they are sitting on a large pile of cash, but the cash isn't just meant to sit there. What they're doing is actually building out their production of met coal. So effectively later, maybe in 2026 roughly or so, depends on timing and delays if things go on schedule, they'll be able to significantly increase their production of met coal. So effectively, instead of buying back stock and sort of quote unquote reinvesting in the coal mines they already have through these buybacks, like AMR and Arch are doing, what they're doing instead is they're physically using that cash to build out new mines, new production, which will add to cash flows, not today, but hopefully later down in the road in a couple of years, through significantly more production than they're producing today. So effectively, they are still reinvesting. It's just not directly through buybacks. They're actually building out new mines and capacity. So for those that like that thesis, rather than necessarily counting on buybacks to increase the price through sort of EPS, some people say EPS manipulation, earning per share manipulation by lowering the share count to increase earnings, Warrior Met Coal is taking a different approach in that they're just going to increase those base earnings by actually just producing more met coal and selling more met coal to hopefully make more profit. So a slightly different strategy. Some people really like this. Some people are saying, I really wish, Warrior Met Coal would still buy back stock here because they think it's cheap, but it's just one different way of doing things compared to, let's say, Alpha, who's primarily doing buybacks, and Arch, who is also mostly buybacks and some dividends. That is basically the coal space. If you're brave enough to invest in coal, kudos to you. It's a rare breed of investors, even for a portion of portfolio. If you do take a look at coal, I would recommend checking out the Coal Trader. They have some nice charts in terms of tracking the met coal prices in the case here, as well as tracking some of the seaborne thermal coal prices. The Newcastle thermal is basically Australian thermal coal pricing. API2 is thermal coal to Europe. And then the South Africa I'm not quite as familiar with, but I assume that's sort of pricing from South African coal. On the met side, Australian and Chinese coking coal futures generally trade fairly similar to each other, but there are some discrepancies. Now these are generally probably for prices for what you would see as like the highest grade of coal. So some of the US met coal producers like Alpha and Arch might see realized coal prices that are below the Australian coking coal future prices. And that isn't something necessarily to be concerned about. That's just naturally the lower grade of coal, met coal that they're producing, just doesn't have quite as high of a premium as the hard Australian coking coals. And if you want to know what thermal coal prices are in the US, you can check out the EIA, Energy Information Administration, where they post weekly what the thermal coal prices are depending on your region. I mentioned earlier about the Powder River Basin. This is where Arch Resources still has some thermal coal production, and Peabody also has thermal coal production in the Powder River Basin as well. What's interesting about those two is Arch is actually trying to wind down or reduce completely over time their thermal coal operations in the Powder River Basin. Well, Peabody is stated that they're maintaining their commitment to producing coal in that region. So sort of different approaches there. One saying they want to divest from thermal coal, focus primarily on metallurgical, and that's Arch Resources, whereas Peabody's saying, you know, we're going to maintain our presence producing thermal coal, see how that goes in the future. I think generally speaking, it probably would be more profitable for both companies if one of them left. Because right now you have two companies producing in the Powder River Basin, at least two large, you know, U.S. coal producers with Arch and Peabody. And with both of them producing and competing, it lowers the prices for both, given there's more supply in that region. So it doesn't really make as much sense if Arch is, like, let's say, not making much money in Powder River Basin. Why are they mining there in the first place? Just focus on metallurgical coal. So if Arch leaves eventually, then Peabody makes more money on the thermal coal side. There's less direct competition in that area. And also Arch makes more money because they aren't spending costs trying to mine thermal coal at low margins when they can just focus on their higher margin metallurgical coal segment. And for reference, the Powder River Basin serves this area in the west, Wyoming, Montana, where there's very large thermal coal reserves. And in terms of basins or areas where coal is produced in the US, it's by far the largest or area that produces the most coal. That's why when we're looking at the prices for each dollar per short ton of coal, it's why the Powder River Basin prices are so low compared to the other basins. Is because one, there's so much coal being produced, but two, it's kind of in a landlocked area, so there's not a lot of easy ways to transport or export this coal to other areas. And that gets a bit to sort of the market dynamics of coal, is that you'll notice that in many cases, even though it's a global market for coal, obviously there's a lot of localization within those markets. So certain coal in certain areas may have very different pricing from other coals in other areas. Okay, with all of that, let's move on to the last section, which is uranium. Now, uranium is a very different market from these other three, and particularly most different from oil in the sense that, well, oil is globally traded every day, every second, every minute. Trades are happening around the world. Uranium is almost the polar opposite. Most uranium contracts are done privately. They're done over long periods of time. We're talking about years, and they're negotiated far in advance as well. We'll get more into that in a bit, but first we'll take a look at the sector overview, sort of ways to invest in uranium. You basically have mining stocks. You have some exploration stocks, which I wouldn't really consider as investment. That's more speculative, but they can be correlated with the price of uranium. And then you have spot physical uranium, which we'll get into a bit with the Physical Uranium Trust, which is basically investing in the commodity itself, mostly focused on price movements in terms of expecting that the price of uranium will increase, and rather than going the mining route, just buying the physical. The use case for uranium, I mean, if we're not talking about, you know, nuclear weapons and things like that, the primary use case is it's Earth's most energy dense fuel. So it's ideal for baseload electricity generation. So if we go back to that California electricity generation chart for that period in time, you'll notice this sort of neon green is the nuclear. That is the uranium fuel. And you notice, see how much variation there is for the other fuels? Nuclear is the most ideal for baseload energy. You'll see this bar, it's almost completely straight. That's because when these nuclear power plants are turned on, they turn on and they generally stay on and stay in operation continuously. So this is energy that's exceptionally good for base load, and it's clean energy too, as long as the nuclear waste is disposed of properly, which in most cases it is. But given that nuclear runs continuously at full capacity, there is no real ability to scale up or scale down power generation from nuclear. So you need, let's say, natural gas as a complement to that to be able to meet the variable electricity demand that comes in and out. But that being said, in terms of base load, nothing really beats nuclear. So the investment thesis is that there's more global demand for uranium than there is global supply, especially at current prices under $100 per pound. So what this means is that it's implying that the prices must eventually rise for this supply-demand mismatch to be solved. And the thing is, demand from utility companies is effectively inelastic. I don't have the exact quote or statistics, so you can trust me or you can look it up yourself. But I think for most utility companies operating, at least in their nuclear segment, the cost of fuel is something like maybe 5, maybe 10% of the budget. So even if at, like, let's say $100 per pound of uranium, let's say the price goes to $200 per pound. If that was originally 5% of the budget, it's now 10% of the budget, which, to be fair, is still a significant increase, but it's not necessarily something that's totally out of the question compared to what it seems like when you see the price doubling. You think, oh my gosh, that's a huge increase. You know, utilities are they're not going to buy that. When in reality, if they need the energy, they need the energy. They can't just not have uranium because then they're not going to produce energy. So they'll have to pay whatever price is available in the market. And if that's 200, well, then their cost of operations increase by 5%. It is what it is. So that's what I mean by inelastic demand. The utility companies are the ones that are really the purchasers. And many of these companies, maybe not necessarily so in the US, but in other jurisdictions, are state-owned utility companies. So what they end up doing is they're ending up buying the uranium, or when they buy the uranium, they will just pass on the price to either taxpayers, or I guess in the case of privately owned and operated utility companies, that price just gets ended up passing on to consumers. So either way, demand is inelastic from the perspective that these utility companies need uranium to operate and they can't operate without it, so they have to buy it. And it's also inelastic from the perspective that they aren't even the ones that are taking on the full brunt of the price increase of uranium, because they simply pass that on to the downstream customers, whether that is the customers themselves or if it's a state-owned utility, the taxpayers, or however they decide to pass on those costs. And even so, all that, maybe as a third point, the price of the fuel, uranium, isn't even a large portion of the operating budget of most of these utility companies' nuclear operations. So it isn't even that large of an impact, even if prices, let's say, double. So now we go to market dynamics, which is another reason why uranium is so different from oil, is that production is highly concentrated just by a few countries and companies. It's also a very low liquidity market, and most sales are done through long-term contracting. So in terms of production of uranium, 2/3 of the world's production is from just mines in Kazakhstan, Canada, and Australia. And you also have Namibia as a top 4 producer as well. But if you look at that, those 4 countries, that makes up about 70% of the world's supply. And you'll notice as you go down the list, the production drops significantly. So in terms of market dynamics, very concentrated by just a few countries and companies. So how to invest in uranium? Basically, there are not many options. It's very limited. So you have, in terms of if you want to invest in a stock or a company, your primary option is Cameco. That's the largest uranium miner in Canada and the largest publicly traded uranium company that one can invest in the US on US exchanges. The other option, potentially a more direct option, is through the Sprott Uranium Trust. The US over-the-counter ticker symbol is SRUUF. This is a physical uranium trust that holds currently about $6 billion worth of uranium. So when you're buying a share in the Uranium Trust, you're buying a fractional ownership of this big pile of uranium that they have stored in Canada. And the purpose of this trust is to generally track the price of uranium, though it does sometimes trade at a premium or discount to their net asset value or the current market price of that uranium supply that they have. Most of the time, the uranium trust is trading at a discount, but there are some periods where it is trading at a premium. So there's something to keep in mind if you're considering adding to a position or opening a position, is that ideally you want to buy not at a premium and you want to buy at a discount, particularly if you buy at a large discount, say, then you have potential upside from not only uranium price increasing, but also from that discount closing over time. Historically, it has traded at a discount, but does tend to get to zero or premium at some points in time as well. So unlike some trust ETFs where the discount continues to decline and it seems like it'll never get back to net asset value, in this case, although it does trade at a discount the majority of the time, it does, or there are periods where it gets back to net asset value, or at least reasonably close to it. Another thing to consider about discounts is it may not be just maybe negative sentiment on the trust, but it may be more of a reflection on where investors in the trust are thinking uranium prices are going in the short-term future. So as an example of this, I think in March of 2024, the net asset value, or the sort of true market price of the uranium that they were holding in the trust, was around $23.50 per share, whereas the actual share price was, let's say, around maybe $20 or so per share. So a fairly significant discount there, but in reality, what potentially was happening was investors were selling off in anticipation of the market price of uranium coming down, which in fact it did come down, and that decreased that discount significantly. So it was a discount of 15%, then decreased to basically minus 1%, or almost at net asset value. That's an instance where the discount was actually sort of showing some foresight into thinking that the uranium market will decrease. However, that's not always the case, as let's say going back to just a year prior to that, in March of 2023, where the net asset value in the trust of the uranium was around $12.50 per share. The market price was around $11. So in that case, there was a discount of, if we go back to March, there was a discount of roughly 11%, or 12 to 11%. In some cases, maybe even 14, 15%. And what happened there is that investors may be anticipating a decrease in the uranium price, but here the uranium price kept increasing. So this discount actually persisted for some time until eventually it started to close, as investors realized, oh, you know what, the uranium price is actually not going down, it's going up. There's no reason for the discount to be this large. And investors see that and say, oh, well, then if that's the case, I'm going to buy now and capitalize on not only the increasing price of uranium, but also this discount, which will eventually close, as it did over the next several months or so. And then you get more upside and sort of a little bit of leverage there. Not actual leverage, but a little bit of extra enhanced return from the discount closing closer to net asset value. That's some of the dynamics there when investing in the Sprott Uranium Trust. I sort of skipped over Cameco for a bit, but Cameco is the largest miner of uranium in Canada and one of the largest miners globally, and the largest publicly traded miner that you can purchase on a US exchange. And Cameco will do their sales of uranium not necessarily on the spot market, which is what this blue line is tracking monthly, but they price most of their uranium on the long-term market, which is this sort of gray line that they're tracking monthly. But what you'll notice though is that while the spot market is volatile, the long-term market and the spot market generally move in the same direction. We can get a longer term view of this and see the dynamics here. So in the case where we had the last uranium sort of bull run from 2000 to let's say 2007 or so, we had the uranium spot price and uranium long-term price very highly correlated. And then afterwards, there's a little bit of divergence as the long-term price seemed to be a bit on a lag compared to the short-term spot price. So in other words, while the spot price decreased significantly and did it at a faster rate, the long-term price also decreased just at a slower rate following the short-term price. And it looks like from 2017, where the uranium spot price bottomed, has been increasing steadily ever since, although the long-term price only started to bottom 2018, a bit later, and then has started to increase since then following the spot price. So if the uranium spot price continues to stay at or around 100, or even goes through 100 and higher like it did in 2007, then one would naturally expect that the long-term uranium price would follow as well, just on a bit of a lag, and continue to increase and ratchet up. And that's going to be useful for Cameco later on as more of these contracts start coming in for renegotiation. They're going to be based and looking at that long-term price. So effectively, the longer the uranium spot price stays high and or continues to go up, the more that it will benefit Cameco as they renegotiate these longer term contracts. All of that is relatively pretty obvious stuff. I mean, if Cameco is a uranium producer, if uranium prices go up, they're going to make more money. It's not too complicated from that perspective. However, it is important to sort of understand the dynamic between the spot price and the long-term price, because let's say if spot price immediately spikes to 200, for example, if the spot price spikes and then comes back down significantly, like let's say it's something like this that happened in 2007, if that occurs, then what may happen is we might see a similar pattern with the long-term price where it goes up, but it's not going to go up all the way to that high peak on the spot price. It'll go maybe partially the way, but then most people won't be willing to pay long-term contracts at whatever that spike peak price is. In that case, Cameco may be able to lock up some long-term contracts at an elevated rate, but they may not be able to lock up anything at that high spot price. If you compare that to the physical uranium price, this might actually much more closely track the spot price of uranium, because effectively that's what the trust is designed to do. And in this case, if we look at the spike of price that happened in 2021, we saw the price of uranium spike fairly significantly. And in that case, even the price of the trust went over NAV, in that case, creating a premium. In this case, a very significant premium at one day, whereas almost 30% premium, which is way too high. So if you see premium like this, you want to sell and take advantage of the extreme price over NAV that the trust is trading at. Now, that may have had something to do with the fact that this trust was recently introduced and there's not a lot of liquidity and people are entering into the trust since it's new and exciting and willing to pay premium, even though it's not really a good long-term strategy. Now that that premium is sort of dissipated and we're in a discount again, that may not occur to as such an extent. But it is possible, if there's a significant rise in the spot price, that investors who are looking for a vehicle, and especially speculators who may be willing to pay a premium, will be jumping into the Sprott Uranium Physical Trust as a way to express views that they think the short-term uranium price will go even further. In that case, it wouldn't be totally unsurprising to see the uranium spot trust be at a premium if the price were to spike significantly, like it did in 2007. All this is to say is, depending on where you think your uranium price is going to go and for how long it'll be at that peak price or at a higher level price, can maybe influence whether or not, let's say you invest in Cameco as a mining company of uranium or as the spot trust directly. If you think that we might get a scenario where there could be, let's say, like a short squeeze, so to speak, of uranium, not necessarily saying this will occur, but if, let's say, global supply is less than global demand and eventually utilities need to rebuy, it almost kind of makes sense that they're going to have to pay a higher price if they want to get the uranium they need. So if you think that there's going to be a sudden spike, but eventually that'll get resolved out, then you might consider opting for investing with, let's say, the spot uranium trust, because you might be able to capitalize on more of that full upside swing through the price increasing. Whereas if you were investing in Cameco, you definitely would get some upside as people expect that uranium prices will be higher, but the long-term price, which will ultimately affect the long-term business fundamentals of Cameco, might not increase as much as the full spot price spike. However, if you're under the belief that uranium prices might not see a sudden peak, but is more of a gradual increase in price that is more steady and takes a longer time and likely won't dissipate as fast as it did in 2007 to 2008 and 2009, and it's maybe it gets to a higher price and then sort of stays there or gradually increases, then it might make sense to potentially invest with Cameco, because in that case, Cameco will be able to benefit from a longer term uranium spot price, or excuse me, a longer term uranium price. They'll be able to sign more deals at that higher price, make more margin, make more profit, and they'll be able to do this for a long period of time, which maybe is longer than the market is currently anticipating. So if the market thinks it's going to be a spike like this in the spot market, it might be underpricing Cameco if it actually ends up being a longer term or gradual increase in the uranium price. So I know that was sort of a lot on the difference between Cameco and the Sprott Uranium Trust, but there's sort of just two different ways to view and express an interest in uranium and how to potentially invest in that. I will mention though that for the Sprott Physical Uranium Trust, the management expense ratio is 0.71% or 71 basis points. And for ETFs, that is actually quite high. One could argue it's understandable that a company that is holding and storing physical uranium, like a radioactive substance, is going to have a higher expense ratio than, let's say like an index fund ETF. So from one perspective, that's understandable. On the other hand, 0.71% is still a fairly sizable expense ratio. So you do need to keep that in mind if you're planning to hold this for a longer period of time, that will start to eat up and take a chunk of your returns the longer you hold it. Now, hopefully if uranium prices increase, then that really doesn't matter as much because there aren't really too many other investment vehicles aside from Cameco, which you could express, a positive or long-term bullish view for uranium. But just keep in mind that if, uranium prices tread water, then your uranium per share will decline over time as that management ratio gets taken out of the per share value for the net asset value. There are some uranium ETFs specifically provided by Sprott. I think there's a few other ETFs as well. I think, the Global X ETFs, Uranium ETF is another one. But those generally have either what are called miners or junior miners, and maybe a bit more speculative, which we discussed here up front. I wouldn't necessarily have these be my first choice for investing in uranium. They are a bit more quote unquote diversified as you have more exposure to different companies. But if more of those exposure is to more exploration and speculative companies, then it may net be less beneficial for someone compared to, like, let's say, okay, I'll just invest in Cameco as the main uranium miner. Just something to consider. I mean, you can take a look at the holdings within each of these ETFs, for instance, like the Sprott Uranium Miners ETF, and they do have some of the largest miners and even have exposure to Kazatomprom, which I'm probably mispronouncing, but that is the main producer of uranium in Kazakhstan. So that is one way to gain exposure to that company, which you likely would be unable to get exposure to directly. If you want to track the spot and term uranium price, Cameco has charts on their website, which is what we were looking at before with these monthly spot and monthly long-term uranium price. If you're looking for sort of the day-to-day market spot price of uranium, then Numerico has a website where you can check out the latest trades for uranium. And in this case, you can sort of see and track what the most recent price is based on the latest trade that went through. There are some periods where you have days where no trades are made at all. And that's actually completely normal for a uranium market, which is relatively a liquid, low volume market. So don't be too surprised by that. And also, given that it's, low volume, low liquidity market, don't also be surprised by significant swings up or down in the uranium price in the short term. But this is one sort of helpful tool to keep tabs on the uranium market, especially day to day. Although long term, you don't really need to worry too much about the day-to-day volatility, especially given it's a low volume market. But just a tool that's in your toolkit if you want to be able to use and help track this for your own investment thesis. So I personally have owned or own the Sprott Physical Uranium Trust as a way to potentially invest in uranium and bet on a long-term increase in uranium price, primarily on the thesis that, at least over the next 4 or 5 years, global demand is higher than the global supply currently. So price likely will have to increase. If utility companies are able to get their supply, they'll have to pay more. Just my thesis might be wrong, but that's how I'm thinking about it, at least as a portion of my portfolio. And that is your energy stock investing course for beginners. Hopefully you found this helpful to navigate at least some of the oil, natural gas, coal, and uranium markets and investing options you have for them. If you've invested in energy stocks before, I would love if you would leave a comment and express what you invested in or what you learned from that investment as well. I think that really helps new investors a ton, is to see the experience of others and learn from either their mistakes, their successes, and their experiences in general, and help get a better holistic view of the energy market in general. If there's things I missed or things I made a mistake on, feel free and please do correct me in the comments below. I'll take a look at those and try and upvote those as I can. And if you made it all the way to the end, definitely consider subscribing. I'm going to be doing much more long form, heavy value based educational content like this going forward. So if you're interested in that and want more useful information like these kinds of videos, definitely consider subscribing. Again, hope this was helpful for you guys, and thank you for watching.